Hello and welcome to the Tax Roundup for August. And while we're waiting on the final composition of the Senate and to see that draft legislation for all those budget announcements, the ATO is keeping us busy. We're taking a look at the new clarification on the deductibility of gifts, some new tools and benchmarks out from the ATO for small business. We're going to look at a case that looks at when is a loan really a loan from a company to an individual. But first up, Michael Carruthers is going to take you through the new law companion guides for those small business restructure rollovers.
Now, a lot of practitioners would be aware that the new small business restructure rollover rules commenced from 1 July 2016, and this provides some of our clients with the opportunity to restructure their business affairs in possibly a more tax efficient way than what they've been able to in the past. Now, with the introduction of these new rules, the ATO has been starting to release some guidance material around how the rules operate, the conditions that need to be met to qualify for the rules in the first place as well. And we have seen the finalisation of some law companion guidelines, LCG 2016-2 and LCG 2016-3, which deal with different aspects of those new rules. One of those guidelines deals with the main condition, well, one of the main conditions of the rollover, which is that that transaction that occurs must be part of a genuine restructure of an ongoing business. So that guideline looks at, well, what sort of reasons would be acceptable in arguing that the transaction is part of a genuine restructure of an ongoing business. That might be things like asset protection reasons, simplifying your overall business affairs. It could be you're looking to maintain or hang on to some key employees by offering employee shares, that sort of thing. It could be wanting to bring more capital into the business to help it to grow and reach the next level. But the ATO does provide some examples of situations where the reasons may not be within the scope of these rules, and that might be where it looks like the restructure is part of an eventual sale of assets or trying to extract wealth basically from the business itself. So it is worth having a look at, particularly if you do have clients who are looking at maybe using these rollover rules. The guidelines do expand a little bit as well and look at other issues that weren't covered in the draft version. So if you've looked at the draft version before, it's well worth having a look at the final version. Things like maintaining underlying ownership of assets. So where discretionary trusts are involved, for example, the ATO does provide a little bit more guidance on what may and may not be acceptable. The ATO also confirms that these rules are not intended to apply where shares are transferred or units in a trust are transferred. Now, they may well be active assets, and we have some active asset tests within these rules, but the way these rules are drafted means that they are not really meant to apply and cannot really apply to situations involving the transfer of shares in a company or units in a trust. The other guidance looks at, well, what are the implications of applying the rollover? Now that you've met the conditions, what happens from a tax point of view? And the guideline basically runs through a number of examples and a number of scenarios looking at, well, what happens from a tax point of view in terms of setting the cost of assets, the CGT implications down the track, the loss rules, how they might apply. And again, if you've looked at the draft version of that guidance, it is again worth looking at the final version because it does expand upon and introduce some new scenarios that weren't covered previously. For example, what happens when you have assets in a small business general pool and they're transferred over? How do you figure out the depreciation deductions in the year of the change? That's one of the things that is covered in this particular final version of the guide. So we do have some guidance. It's great that that guidance is nice and early, as opposed to being 2 or 3 years down the track when people have already done these transactions and not really sure how the rules are meant to work. So if you do have clients who are looking at maybe utilising the rules, these are worth looking at both in terms of determining whether they would qualify for the restructure rollover relief in the first place, and then trying to figure out what are the ongoing tax implications if the transaction does proceed.
From the ATO this month, Rae takes you through the clarification from the ATO on the deductibility of gifts.
The ATO have issued TD 2016-14, which confirms their view of a long-established principle that if a business taxpayer gives a gift to a current or future client and there's a reasonable expectation of earning assessable income, then that gift will be deductible. Now, obviously, if the gift in question is either private or domestic, or could be considered entertainment, then it wouldn't be deductible. So if the gift has been given to, for example, the taxpayer's brother, you'd want to be able to confirm that there is some evidence that that is in relation to an actual income producing activity. So your classic example would be the real estate agent who gives the nice bottle of bubbly when they've just sold the property. If that's done to build up the relationship with their client, hopefully an expectation of future referrals, then great, there's sufficient nexus there, and the giving of that gift can be deductible. So a happy taxpayer and a happy client.
Back to Rae to look at those benchmarks from the ATO and those new tools to help small business.
The ATO have issued 2 pieces of guidance for small business taxpayers. Now, the first one is for individuals who are in receipt of small business income. So this would be, for example, a sole trader, somebody who's carrying on business through a partnership, or perhaps a beneficiary of a trust that is itself carrying on a small business. As you know, the Tax Office introduced a small business tax offset starting for the 2016 tax year, and it is capped at $1,000. It is based on 5% of the small business income. So what the ATO have done is they've issued a calculator on their website which will help taxpayers calculate the amount of small business income upon which that tax offset will be based. It does not actually calculate the offset itself, just the amount of small business income that would have to be separately identified on the individual's tax return. So at least there's some help there. Separately to that, they've also introduced some small business benchmarks. Now, the Tax Office have been using the benchmarks for quite a few years now, but they've introduced additional ones which should provide some guidance to small business taxpayers in those specific industries. The thing that to notice is the Tax Office actually use these benchmarks themselves to identify which taxpayers might be outside those benchmarks, and those taxpayers are more likely to be at risk for an audit or review in relation to their business. So it's probably worthwhile taking a look for your clients and that industry. Is there a benchmark available? Do they fit within that benchmark? And if not, why? Maybe take a look at that and ask the questions before the ATO decide to ask the questions. Separate to the tax issues, it might also provide some commercial assistance in looking at how they're performing within the industry and maybe where there might be some more efficiency to look at. So overall, some help from the Tax Office that might provide help in a non-tax area.
In cases this month, Michael's going to take you through that case looking at when is a loan really a loan? Does it make a difference in terms of timing when the loan agreement is put in place, or is there something else? Across to you, Mike.
Now this month we thought we'd bring you a bit of an update on a case which is in a way a continuation of a trend that we're seeing from the ATO when dealing with particularly private groups involving companies. The Roundtree case, which was an AAT decision, deals with basically a situation where a number of related companies had advanced funds to a particular individual. Now that individual claimed that those advances were in fact loans, whereas the Commissioner took a different view. The Commissioner said, well, the money that's been paid out of these companies to this individual, we don't think they're loans, we actually think it's just straight income and taxed on revenue account in the year it's been received without the kind of maybe the deferral that might come from a loan arrangement. So the AAT basically had to look at whether these advances of funds were in fact loans. And if so, that would obviously significantly impact on the tax treatment for this taxpayer. Now the AAT at the end of the day agreed that some of the advances could be treated as loans because there was enough evidence to justify that. But in other instances, the AAT just wasn't satisfied that those advances could actually be called loans. Some of the problem areas, I guess, where the AAT picked up were, in many cases, there just weren't formal loan agreements in place. So there wasn't written evidence setting out loan terms, explaining that a loan had actually been made. The AAT noticed that in those instances as well, there was a lack of other evidence that might have suggested these things were really loans. So there was no directors' resolutions that referred to these advances being in fact loans. The other thing that the AAT mentioned was that in this case, the taxpayer only started making what they called repayments against these advances after they became aware that the ATO was looking at their financial affairs, basically. So they started to make these repayments when it looked like the ATO might kind of be getting into a bit of an argument with them over what these things really were. So on balance, the AAT in some instances just wasn't satisfied there was enough evidence other than the taxpayer saying they were loans. There just wasn't enough other corroborating evidence to support the fact that these were loans. The result being that these advances paid out from the company to the individual would just be taxed as income. Now, one of the other arguments that the taxpayer ran in this case was to point to Division 7A. And the taxpayer said, well, when a company makes a loan to a shareholder, the Division 7A rules provide a little bit of flexibility in timing when it comes to putting a complying loan agreement in place to avoid the worst of Division 7A. So the taxpayer said, well, it's okay for Division 7A purposes to have that written loan agreement put in at a later point in time. The tribunal wasn't convinced by that argument and said, well, yes, the Division 7A rules do allow you some time to formalise and document the loan agreement that basically is already in existence, but that doesn't mean that you actually made a loan in the first place or the company made a loan in the first place. That is only relevant when the advances are in fact loans. That's just giving you a bit of extra time to formalise and put that loan agreement in writing. You still need to go back and look at whether this arrangement is actually a loan in substance or not. So in this case, that really didn't change the result from the AAT's point of view. The AAT said, well, yeah, if they were loans, then that might help you in avoiding Division 7A. But in this case, we're not dealing with that situation. We're dealing with amounts that are just income. They weren't loans to start with, so those rules are just not relevant to your situation. Look, I think, again, this is another case, we've seen a few of these in recent years, where the ATO could potentially run a Division 7A argument, but has kind of left Division 7A to the side and just started with the proposition, I guess, or the idea that the funds coming out of a company to a particular individual, it might be a shareholder or a related party, should just be treated as ordinary income. And the ATO is not going straight to Division 7A. So it's an important lesson and reminder to practitioners and their clients around the importance of documentation. So if you think this thing is meant to be a loan, well, make sure there's documentation that suggests and proves that that's actually what you were thinking at the time. And make sure that the evidence around that is consistent as well. So it is a trend that we're seeing from the ATO in recent years. There have been a number of cases that have looked, I guess, at this issue a little bit differently to what we might have thought in the past, but certainly a really good and timely reminder to practitioners and their clients to make sure things are in order, particularly from a documentation point of view.
And that's the tax roundup for this month. Don't forget, if you're not a member of Knowledge Shop, take a look at what we have on offer, because we have a full suite of the work papers, standards, checklists that you need to manage this financial year successfully. Give Julie a call on 1800 800 232 and we'll look forward to talking to you soon.